In 2008, millions of people watched their retirement accounts drop by 30, 40, 50%. Some sold everything. In 2020, markets crashed at record speed. Panic everywhere. Again, people sold. By 2023, markets were hitting new highs. The same pattern, different decade. Here's the uncomfortable truth. The stock market doesn't reward intelligence. It rewards behavior. And in 2026 to 2027, behavior will matter more than ever. Because we are entering a strange phase of the cycle. Artificial intelligence is reshaping industries. Interest rates are no longer near zero. Governments are carrying historic levels of debt. Geopolitics is tense. Valuations in certain sectors look stretched. Others look ignored. If you're a beginner right now, it feels confusing. Should you wait? Is it too late? Is everything overpriced? Is a crash coming? These questions have existed in every single decade. The stock market is not a prediction machine. It's a pricing machine. And in 2026 to 2027, understanding that difference will separate investors from spectators. So let's break this down. Not with hype, not with fear, just the mechanics. First, what the stock market actually is. Imagine thousands of businesses, some tiny, some global giants. They need money to expand. Instead of borrowing everything from banks, they sell small pieces of ownership to the public. Those pieces are shares. When you buy a stock, you're not buying a number on a screen. You're buying a claim on a real company's future profits. Factories, software, patents, employees, brand power. The stock market is simply the marketplace where those ownership pieces trade hands. Now here's where beginners get confused. Prices move every second. News headlines scream. Charts flash red and green. It feels chaotic. Companies are earning money or losing it. Over long periods, stock prices follow earnings. Not headlines, not predictions, earnings. Between 1926 and today, the U.S. stock market has returned roughly 9 to 10% per year on average before inflation. That includes wars, recessions, bubbles, pandemics, political drama. That number isn't magic. It's the result of businesses growing profits over time. But averages hide volatility. Some years the market is up 25%. Some years it's down 20%. And this is where most beginners make their first mistake. They treat volatility as danger. Volatility is not danger. Permanent loss is danger. In 2026 to 2027, volatility is almost guaranteed. Interest rates remain a variable. AI-driven productivity could boost profits in some sectors while crushing others. Government spending may continue influencing liquidity. There will be narratives. Lots of them. But narratives don't compound. Earnings do. Now let's talk about how you actually start. Step 1 is not picking stocks. It's understanding risk. If you invest money you'll need in the next 12 months, you are gambling. The stock market can drop 30% and take years to recover. Historically, holding periods matter. Over any single year, outcomes are unpredictable. Over 10 to 20 years, probabilities shift dramatically in your favor. Time transforms risk. This is why the beginner's roadmap starts with one question. How long can this money stay invested? If the answer is less than 5 years, caution. If it's 10 years or more, history becomes your ally. Step 2 is diversification. In 2026 to 2027, individual companies will look tempting, especially in technology and AI. Some will dominate headlines. Some will collapse quietly. You cannot reliably predict which is which. Broad index funds exist for this reason. Instead of betting on one company, you buy hundreds or thousands at once. You own the market itself. When one fails, another rises. This isn't boring by accident. It's boring by design. And boring has a strange track record of outperforming excitement. Consider this. Missing just the 10 best days in the market over a 20-year period can dramatically reduce total returns. And those best days often occur during periods of extreme fear. Which means if you jump in and out trying to, time crashes in 2026 or 2027, you are likely to miss the very rebounds that generate long-term gains. Now let's address valuation. People often ask, is the market expensive right now? In certain sectors, yes. In others, no. The market is never uniformly cheap or expensive. It's a mosaic. Valuations are often measured using price-to-earnings ratios. In simple terms, how much are investors willing to pay for $1 of profit? In low interest rate environments, investors pay more. In higher rate environments, they pay less. As rates fluctuate in 2026 to 2027, valuations will adjust. But here's the uncomfortable math. Even if you invest at a slightly expensive time, long-term compounding can still work in your favor if earnings grow steadily over decades. The biggest risk isn't investing at the wrong month. It's never investing at all. Let's talk about compounding. If you invest $500 per month at an average annual return of 8%, in 25 years you're looking at roughly $475,000. In 35 years, over $900,000. The jump between year 25 and year 35 is larger than the first 20 years combined. That's compounding bending the curve. And here's the irony. In the first 5 years, it feels underwhelming. Growth is slow. The numbers seem small. Doubt creeps in. Most people quit in this phase. Not because the system failed, but because it worked too quietly. Now let's contrast hype versus reality. In every cycle, there are promises of fast money, hot sectors, breakthrough technologies, once-in-a-generation opportunities. Some are real. Many are exaggerated. In 2026 to 2027, AI stocks will likely dominate attention. There will be legitimate innovation. There will also be overpricing. History suggests both can coexist. Remember the dot-com era. The internet did change the world, but many early companies went to zero. The technology was real. The valuations were not. As a beginner, you don't need to outsmart the market. You need to survive it. Survival means avoiding concentrated bets you don't fully understand. It means ignoring daily noise. It means continuing to invest during downturns when headlines predict collapse. This is not heroic. It's mechanical. Now zoom out. The stock market reflects human productivity. More efficient factories, better software, medical breakthroughs, logistics improvements, energy transitions. When productivity rises, profits tend to rise. When profits rise, stock prices follow over time. But there are risks. Demographics in certain countries are slowing. Debt levels are high. Geopolitical fragmentation could impact global supply chains. Climate events could create economic shocks. These forces will influence markets. In 2026 to 2027 and beyond, the market does not move in a straight line upward. It moves in cycles. Expansion, euphoria, contraction, fear, recovery. If you enter the market expecting smooth growth, you will be disappointed. If you enter expecting turbulence but staying invested anyway, you align with historical probability. So what does the beginner's roadmap actually look like? Consistent monthly investment, broad diversification through low-cost index funds, long-time horizon, minimal trading, emotional discipline during downturns, periodic rebalancing. That's it. Notice what's missing. No secret formula, no insider signals, no complex trading strategies. Because complexity often masks risk, and risk, misunderstood, destroys compounding. The stock market in 2026 to 2027 will feel noisy. It always does. There will be days when portfolios drop sharply, days when markets surge unexpectedly, days when experts contradict each other on live television. Underneath that theater, companies will continue building products, hiring workers, competing, innovating. Some will fail. Many will adapt. If you own a broad slice of that activity, you participate in its long-term growth. If you stand outside waiting for perfect clarity, clarity may never arrive. The uncomfortable reality is this. There is no perfect entry point, only disciplined participation over time. In 10 years, the headlines of 2026 will feel distant. The volatility of 2027 will look small on a long-term chart. But your behavior during those years will compound forward. The stock market does not care about your intentions. It responds to capital, patience, and time. So as we move into 2026 to 2027, the real question isn't whether a correction will happen. It probably will at some point. The real question is whether you will build a system that continues investing through it. Because decades from now, when you look back at this period, it won't be defined by a single crash or rally. It will be defined by whether you chose to participate in the engine of global productivity or watch it from the sidelines. And that is the distinction most people miss. The stock market is not a scoreboard for the next quarter. It is a transfer mechanism between patience and impatience. In 2026 to 2027, There will be noise. There will be volatility. There will be confident predictions delivered with absolute certainty. Some will sound brilliant in hindsight. Most will fade. But the underlying system will continue doing what it has always done, pricing risk, rewarding productivity, punishing excess, and compounding ownership over time. You don't need to predict the next boom. You don't need to avoid every downturn. You don't need to be early to every innovation. You need structure, a clear allocation, a long horizon, disciplined contributions, emotional control when prices move against you. That is the beginner's real advantage. Not speed, not timing, consistency. Because in the end, markets amplify behavior. If your behavior is reactive, your results will be unstable. If your behavior is systematic, your results tend to compound. Years from now, the headlines of this cycle will be archived. The fears will look smaller. The rallies will look obvious in retrospect. What won't be obvious is the decision you make quietly, to participate or to hesitate. The stock market will keep moving either way. The only unresolved question is whether, when the next decade passes, you'll see this period as noise you survived, or the moment you finally began building ownership in a system that never stopped growing.